Welcome to Money Roots, the podcast where personal finance gets personal. Each week, Amy and her guests dig deep into the world of finance, making it more approachable and understandable for everyone, no matter where you are on your financial journey. From savings and investments to budgeting and planning, we'll bring you practical advice, inspiring stories, and expert insights. We believe that everyone has the potential to grow a healthy financial future, and we're here to help you nurture it. So whether you're a financial guru or just starting to plant the seeds of your financial knowledge, this is the place for you. Get ready to uncover the tools and strategies that can help you thrive financially. So without further ado, let's dive into today's episode of Money Roots.
Hello, Money Root listeners. This is Amy Irvine, CEO and founder of Rooted Planning Group. One of the reasons that I launched this podcast so many years ago was because I wanted to make sure that there was education out there that brought it down to a non-intimidating level. And during periods of volatility like we've been experienced, I really look for opportunities to make sure that I do just that, provide education. If you looked at the title of this particular podcast, I called it Whiplash because I feel like the last couple of weeks have been just that. So I thought it was a great opportunity to talk about the importance of both offense and defense within a challenging market. Now, for most people, offense and defense both start well before an actual event takes place. And it can be any event. It's an unnamed event, right? But it takes place in advance. And that's why we always talk about having a portfolio that is diversified, that is balanced, that doesn't weigh too heavy in one particular stock or one particular sector. Well, over the last couple of weeks, and as of this podcast, I'm recording on April 16th, so it's about a week from release date, certainly concerns that a trade war will lead to a recession have spread throughout the globe. The possibility of retaliatory tariffs is on investors' minds, certainly with China responding with counter tariffs, increasing odds of worst-case trade war scenarios happening. Markets in Asia and Europe have declined alongside U.S. stocks, and there's been a flight to safety as bond prices rise and interest rates fall. Well, so then we get into the topic of, what needs to happen, and a portfolio balance and financial planning are even more important in my opinion. And I realize that may sound like, I'm preaching to the choir a little bit, but they're more important today, in my opinion, than they are when the economy is running on all cylinders and things seem to be going quote unquote well. If you think about it, in sports as well as investing, a winning strategy always requires a combination of both offense and defense. Defense involves maintaining a portfolio that can withstand different phases of the market cycle. The stock market uncertainty and unexpected life events are inevitable. So always being ready to plan for defense is important. But then on the other hand, offense involves taking advantage of market opportunities that emerge from changing conditions. The irony is that while periods of market uncertainty may be unpleasant, they are also often the best time when asset price valuations are the most attractive. So ultimately, portfolios that are tailored towards financial goals need both offensive and defensive. So how can investors position in today's market environment to both protect from risk and take advantage of the opportunities? Well, I would say there's two key principles of long-term investing are, as I mentioned earlier, diversification and maintaining a long-term horizon. This is a showcase of, thinking about it, it's a showcase of, what are historical ranges and outcomes across stocks and bonds and diversified portfolios. It also can be a range of different time horizons. And so when we talk to people, we look at goals and different time horizons for those goals. So for instance, it's easy to see that over just a 1-year period, the stock market can be, it can vary significantly from gaining like 60% like it did in 1983 when the stock market recovered from what's called stagflation fears to declining 41% like it did during the global financial crisis. That's those are 1-year periods or the global crisis was a little longer, right? You get my gist of the topic. Moving beyond just 1 year period, though, stock only portfolios can cause the stomach risk to feel a little uneasy. So putting a balanced portfolio together and diversifying it might reduce the maximum returns an investor can experience, but it also reduces that risk. Now, this is evident when we look at what's happening in portfolios consisting of a 60-40, which is typically what's considered balanced. Now, again, as of this particular recording, so far this year, the S&P 500 is about 13% lower, but a 60-40 mix is only about 4%, 4.6%. Now, there are some, understand I'm not saying that every 60-40 mix is at 4.6%, but on average, that's what we are seeing. I guess after all, the goal is not simply to grow a portfolio at the fastest but most volatile rate, but to have the highest possible probability of achieving your financial goals. A diversified portfolio historically has a much narrower range of outcome, allowing investors to better sort of plan towards those goals. I would say also by extending your time horizon by even just a few years, you can have a significant impact on the range of outcomes. History has shown that since World War II, there has not been a 20-year period in which any of the asset and portfolios have experienced annual decline on average. Now that's a 20-year period. The same is true over a 10-year period for many diversified asset allocations. I think that's important to understand. Now, as I mentioned earlier, volatility can create opportunities. So where are some opportunities? The VIX chart, the VIX is a volatility index indicator, right? So it often is known as the stock market's fear gauge. It can spike on a periodic basis. These peaks, these spikes correspond to sharp drops in the market, such as 2008, 2020, and most recently. These are times when the markets are most nervous. And in many cases, investors feel a situation will never stabilize. Notice I said they feel that it will never stabilize. Now, we can't say that something will or won't happen. We can't guarantee anything, but this is from a historical reference. So if you were to look at returns look at returns of the S&P 500, there are always going to be this level of volatility. I mean, it's again, if you look at it on a day-to-day basis, there's significant volatility. And if you match that up over the VIX, what you'll often see is the spikes of the volatility index are often again, around those periods of time that make people very nervous. Now, for people that they've probably worked with me, they've heard this particular saying, but Warren Buffett has often quoted to be fearful when others are greedy and to be greedy when others are fearful. Now, I've said it a little different way, is to buy on fear, sell on greed. Same meaning, underlying meaning. Now, when we look at periods of time when the market faces, I would say, liquidity rather than solvency concerns, liquidity problems emerge when the market declines. I guess, that it's a big force, specifically those who use leverage or borrowing to sell other assets. So it forces it. This is a liquidity problem. In these situations, prices may decline even when the underlying fundamentals of the assets remain unchanged. These are classic cases when short-term market moves become disconnected from long-term outlooks, creating opportunity for patient investors. So valuations as of today, as of the recording, are actually more attractive as a result of some of the things that have just recently happened. Which assets have helped this year and which ones are more attractive? Well, bonds have played an important role this year as interest rates have fallen, helping to balance portfolios and partially offset declines in other asset classes. But bonds are able to do this because they typically exhibit lower volatility, I say typically, than stocks, and often move in the opposite direction. And again, that's not always. And again, I think you have to look at how assets can be uncorrelated to each other. Valuations are more attractive today after multiple years of strong stock market returns. And while it's still unclear where earnings will settle after accounting for tariffs, the price to earnings ratio of all the overall S&P 500 has declined to 20.7. In some sectors, such as information technology, community service, and communication services, and consumer discretionary, have seen multiple declines amid a broader pullback. So those sectors have actually seen more. Interestingly, assets such as gold, which often serve as safe havens, have struggled more recently. Gold prices rose to a new all-time high earlier this year, resulting in double-digit returns over the past year. Investors are typically drawn to this asset class for many reasons. That they are interested in bonds. It can serve as a store of value in times of uncertainty. However, gold prices have retreated as economic fears have weighed on all commodities. This is why I think it highlights the importance of not focusing only on a single asset class, but viewing it from a holistic portfolio view, I guess you want to say. Now, the tensions between the U.S. and China have escalated, right? So we've heard things for a moment, it was 125, now 145. I think I saw an announcement this morning that was over 200%. This is creating some global tension and can create that uncertainty. And history shows that markets have weathered similar challenges in the past. And despite the headlines, understanding the economic relationship between these two countries can help long-term investors to maintain perspective. Tariffs against all trading partners have dominated the market news, and the last 90-day pause that was just implemented now puts a focus mostly on the U.S. and China. The underlying issue runs much deeper than trade policy alone. Current tensions are a result of this multipolar world in which the U.S. and China are the two largest economies, but with significant global influence, both of them. This is a decades-long shift from the unipolar world in which the U.S. was the only major superpower after the Cold War. This naturally creates new challenges and opportunities for each country. And while there's no easy answers to how the trade negotiations might progress over the next few months, maintaining perspective has become more important for long-term investors. The U.S. and China remain significantly linked through trade, finance, and global supply. What makes this situation different from previous trade tensions is that both the magnitude of the tariffs and the broader geopolitical context. As the U.S. maintains significant trade deficit with China, trade levels above 100% effectively mean the goods crossing either border would more than double in price, all else being equal. This increases the price of goods for consumer, raises costs for businesses, and can slow economic activity. And so the fear of high inflation and worsening profit margins have caused market volatility in the most recent weeks, with a notable shift in the consumer surveys and corporate earnings guidance. Markets have also been worried about how far the White House will be willing to go in escalating with China. Since tariffs at these levels are unlikely to be sustainable in the long run, is it still likely that they'll, represent a negotiation position for the administration? And again, the 90-day pause on tariffs above 10%, except for China, and the exemption for technology products are evidence that the White House main objective seems to still achieve the goals. Their goals, the White House goals. The tariff implemented in 2018 and 2019 provides some historical context for how markets and companies might respond as a situation evolves. Many companies demonstrated resilience by adjusting supply chains, finding alternative suppliers, absorbing portions of the costs, and some passed it on. While markets stumbled in 2018, they did perform well in 2019 and again during the post-pandemic recovery. I mean, I don't think, that's a really tough one to connect the dots to, but the broader scope of tariffs makes it more difficult for companies at this time to depend on that, historic reference. So again, the rally after the 90-day pause, though, I think can show that conditions could improve once things settle down. One thing I also want to mention, I think it's a really important topic to cover with people because I think this is something that they can relate to, I should say. And I'm going to put a chart in the show notes for people to pull up. But I always like to show this to people from a respect of putting in perspective how markets can react throughout a given year. So the chart that I'm going to show goes back to 1990. And it shows a brown or tan or grain bar on it that actually represents what the S&P 500 did for the full year versus the maximum drawdown that happened at some point in time throughout the course of the year. You will notice when you look at that, if you take the time, you'll notice that every year that's listed there has some sort of drawdown. And by drawdown, I mean, where was the low point in the S&P 500? So you'll notice, for example, in 2008, that there's a red dot that says negative 48%. And that was the low point of the market that particular year. When I say the market, I mean the S&P 500. But it closed down 37% from January to December. So even in that particular year, if you had bought at the very bottom, which of course we never know when it's going to be the very bottom, but if you had bought at the very bottom that particular year, then you would have actually gained about 11% by the time all settled down. Now, the very next year, 2009, we started out the year in very negative territory. It was sort of the same trend was continuing from 2008 into 2009. And the turnaround point, when we look back in hindsight, was March 9th of 2009. At some point in time in that year, the S&P 500 was actually down 27%. It ended up for the year being up 26%. So it was a 53% range from that 27% negative to the positive 26%. Now, those are exceptional years. When you look at the chart, you'll see, though, even as of April 11th, the S&P 500 this year was down as much as 19%. And as of April 11th, it's down 8%. I think it's really important to understand that the stock market throughout the course of the year has these ranges, even though when we look at it from a long-term perspective, it has upward swings. And this is why when I'm talking to people about how is this impacting your goals, in the short term, if you don't sell anything, then you're not locking in that loss and it shouldn't impact the goal. I'm not saying tweaks shouldn't be made. I'm not saying that it doesn't match your risk tolerance and you discover that. I'm saying that if we're trying to match the dollars that you're saving and investing to the goals that you're trying to achieve, thinking about those time horizons and how those things are invested. Even when people retire, I often say to them, well, you're not using all your money today. You're using it over the course of hopefully a 25 to 30 to 40 year period of time. So it all should go into bonds or cash the moment that you retire. There should be a piece that's still being invested for the long term. I hope that you have found this podcast helpful and educational. As I mentioned, I'll put that chart in the show notes, and we're always trying to provide additional education to our listeners. So if there's something in particular that you'd like me to dig into a little bit more, please let me know. In the meantime, if there's information out there that you're struggling to understand, send us a note and we'll either try to put it in our newsletter or we'll try to do an additional podcast or maybe even a webinar on the topic. Thank you everyone for listening. And again, I hope this was very educational in nature.
You've been listening to Money Roots, your go-to podcast for making personal finance accessible and approachable. Thanks for joining us today. Amy and her guests have enjoyed guiding you through the roots of your financial journey. Remember, whether you're planting new seeds of financial knowledge or nurturing the growth of your existing financial plans, Money Roots is here to support you every step of the way. Be sure to follow them on Facebook, X, LinkedIn, and Instagram for more resources. And, of course, subscribe to Money Roots wherever you get your podcasts so you never miss an episode. A big thank you to the sponsor, Rooted Planning Group, for making this show possible. At Rooted Planning Group, they're committed to helping you cultivate a thriving financial future. Until next time, keep growing your money roots. Money Roots is made possible by the support of our sponsor, Rooted Planning Group. Are you ready to take control of your financial future? Look no further than Rooted Planning Group, your trusted partner in financial well-being. At www.rootedpg.com, you'll discover a wealth of resources and expertise to help you thrive financially. Rooted Planning Group specializes in personalized financial planning, investment management, and retirement strategies. They understand that every financial journey is unique, and they're here to guide you every step of the way. With a team of experienced advisors, Rooted Planning Group is committed to helping you cultivate a secure and prosperous future. Visit www.rootedpg.com today to learn more about how Rooted Planning Group can help you grow your money roots.